Hi everybody. We're doing changes to bonus depreciation for 2023. My name is Cam.
I'm Cole.
And I'm Carter.
So what is bonus depreciation? It's an accelerated tax deduction. It allows a business to deduct a large percentage of the purchase of eligible assets up front, depreciating them over years. It reduces the tax net income, which reduces the tax liability.
So a little bit of history on business depreciation. It started shortly after 9/11 in 2001 with a bonus depreciation rate of 30%. And this amount has fluctuated between 0 and 100% over the years. After the Tax Cuts and Jobs Act passed in 2018, you were able to take 100% bonus depreciation deduction, and this can be applied on new or used assets, machinery, equipment, vehicles, improvement to property, and even more. Bonus depreciation can have both positive and negative effects in terms of the effect on the tax return. And under the TCJA, the bonus depreciation rates are phasing out over the next couple of years, which we'll get into a little bit later.
Why bonus depreciation was created? Bonus depreciation was created to encourage small businesses to invest in the economy. A company could expense the same total amount over a life of the asset, but bonus depreciation can assist with reducing the tax liability. This is extremely important if you consider the potential impacts on the tax brackets.
So bonus depreciation was founded under the Internal Revenue Code, section 179. It can be used to depreciate new assets and used assets if it is first used by the purchasing company. The qualified purchases between September 27, 2017 and up until January 1st of this year are allowed for 100% bonus deduction. However, so some of the pros and cons of bonus depreciation is that we can deduct a large amount of the asset up front. We can increase the amount of depreciation you can use to decrease the taxable income. It reduces overall tax liabilities and can deduct an asset quicker if you have losses in those years. However, it can decrease the 199A deduction. It cannot be used on depreciation again in the future, and it can lose potential deductions as well. So the change, so next year it will be, okay, so starting in 2023, bonus depreciation will reduce down to 80% from the original 100, and it'll keep on reducing now at 20% over the next couple of years. So like 2024 will be 60, 25, 40, 26 will be 20%, and then 2027 will again have 0. So for 2023, the remaining 20% will use the maker's depreciation format for the remaining life of the asset. And this is just a graph explaining how we are deduct the percentage for bonus depreciation is going down over the years.
So here's a little comparison between bonus depreciation versus normal depreciation, and how it affects the total deduction and how much you're paying per year. So up top is the normal depreciation, which uses the maker's table, which we provided an image of. For example, we're going to be using the 3-year column. So if a company buys software, the tax for the asset is spread over the useful life, and the fixed percentage is based on the maker's table and how much they pay per year. For bonus depreciation, the company also buys the software, but the tax is accelerated with that 80% of bonus depreciation up front, and this reduces the tax liability for the company. And we have an example on how this is demonstrated. So if we bought the same software asset and just used the 2 different methods, the normal method at an asset cost of $100,000 with a useful life of 3 years would use those makers' percentages right there, and then per year you get $33,000, $44,000, $14,000, and then $7,000, and you get your full total depreciation expense of $100,000, which is the asset cost. But if you use the bonus depreciation method with the same asset cost, same useful life, you can take 80,000% up front and then use that same percentages, but use it on the remaining 20,000 of the asset cost, and you get these much smaller numbers, and you still get the same amount, of total depreciation expense, but your deductions change and the amount you pay per year is much different and much smaller. And then these are our references. Thank you.
Thank you.
Still feel like that was short.
Yeah.
I felt like